4 months ago, when Bitcoin was at $126,000, what were you saying? You were saying, if only Bitcoin could drop below 100,000. If only I could get another chance, I would buy so much. Well, the market just gave you exactly what you asked for. Bitcoin is now at $72,400. That's 42% down from the top. That's not just below 100,000. That's a massive discount. And what are you doing? You're panicking. You're selling. You're convinced it's going to zero. Let me tell you something uncomfortable. You never wanted to buy Bitcoin cheap. You wanted to buy Bitcoin while it was going up. You wanted the comfort of momentum. You wanted the validation of green candles. But here's the truth. Wealth is not built buying what feels safe. Wealth is built buying what feels terrifying when the fundamentals say otherwise. And right now, the fundamentals are screaming one thing. Bitcoin has not gotten worse. It has only gotten cheaper. Before we go further, hit that like button right now. And if you're not subscribed, subscribe and turn on notifications, because what I'm about to show you will completely change how you see this market. Now drop a comment. Are you scared or are you buying? Let's see where you stand. Now let's do something radical. Let's ignore the price for 5 minutes and audit Bitcoin like you would audit a company. If you were buying shares in a business, you would look at the fundamentals, right? Revenue, users, security, growth metrics. You wouldn't just look at the stock price and panic. So let's compare Bitcoin in October 2025 at $126,000 versus Bitcoin today at $72,000. Metric 1, network security. This is measured by hash rate. Hash rate is the total computing power securing the Bitcoin network. The higher the hash rate, the more secure the network. In October, when Bitcoin was at 126,000, the hash rate was strong. Metric 2, supply dynamics. Where's the Bitcoin? Who owns it? This is measured by exchange reserves and wallet behavior. In October, there was a lot of Bitcoin sitting on exchanges ready to be sold. Today, exchange reserves are at multi-year lows. Bitcoin is being pulled off exchanges and moved into cold storage. Long-term holders are not selling. In fact, while it's holding more than 10 Bitcoin, the so-called whales, they've been accumulating during this entire crash. Metric 3, leverage flush. In October, the market was loaded with leverage, futures contracts, margin positions. Everyone was betting Bitcoin would go higher using borrowed money. That's dangerous. That's unstable. That's a house of cards waiting to collapse. Well, it collapsed. Over the last 4 weeks, $2 billion in leverage long positions got liquidated, wiped out, gone. And you know what that means? It means the market is clean now. The weak hands, the tourists, the gamblers, they're gone. What's left? Holders, believers, people with conviction. So let me ask you, if the network is more secure, if smart money is accumulating, if leverage is flushed, and if supply is tightening, then what exactly got worse? The fundamentals didn't change. The price changed. And price is just perception. Price is just psychology. Now let's go to the financial markets. Bitcoin was $126,000 4 months ago. Today, it's $72,000. Same asset, same network, same fundamentals, 42% discount. And what does everyone do? They panic, they sell, they convince themselves the asset is broken, they create narratives. Bitcoin is dead. The cycle is over. It's going to 50,000. It's going to zero. Why? Because in financial markets, price dictates narrative. But here's the difference between the supermarket and the stock market. When you buy steak, you can eat it tonight. You know exactly what you're getting. But when you invest in Bitcoin, you have to wait. You have to endure volatility. You have to survive drawdowns. And that's where most people fail. If you bought Bitcoin with your rent money, you are going to panic. If you bought Bitcoin on margin, borrowed money, credit cards, you should be scared because you're not investing, you're gambling. And gambling with money you need is how you get destroyed. But if you allocated 1%, 5%, 10% of your portfolio to Bitcoin, money you genuinely don't need for the next 3 to 5 years, then this 42% drop, it's just noise. It's just volatility. It's just the price you pay for asymmetric upside. But whatever you decide, make sure it's with money you can afford to lose. Make sure you can sleep at night. Because if you can't sleep, you're overexposed. And if you're overexposed, you will sell at the bottom. But if you invested responsibly, if this is money you genuinely don't need, then the question becomes, are you reacting to price or are you analyzing fundamentals? Because those are two very different things. Now, let's talk about the elephant in the room. The S&P 500 just hit 7,000 points, all-time highs. Meanwhile, Bitcoin is at 1-year lows. Stocks are ripping. Crypto is bleeding. What's going on? This is what I call a temporary liquidity rotation. Money didn't disappear. Money just moved. Capital flowed out of high-risk assets like crypto and into moderate-risk assets like tech stocks. Why? Because of fear. But here's what history teaches us. These divergences don't last. They're temporary. They're inefficiencies. And when they close violently. Let me show you what happens when Bitcoin and the S&P diverge like this. In 2016, stocks were making new highs while Bitcoin was consolidating around $600. Everyone thought Bitcoin was irrelevant. Then Bitcoin went from 600 to 20,000 in 18 months. The pattern is always the same. Bitcoin lags during fear, then Bitcoin explodes during the recovery. Why? Because Bitcoin is a leveraged bet on liquidity and risk appetite. When risk appetite returns, Bitcoin doesn't just catch up, it overshoots. And given that the economy is expanding, the PMI just crossed 50, corporate earnings are strong, and liquidity is still abundant, which scenario is more likely? I'll let you decide. What I'm showing you is pattern. I'm showing you probability. I'm showing you what historically has happened when these conditions align. But probability is not certainty, and past performance doesn't guarantee future results. So if you're watching this and thinking, okay, I should buy Bitcoin, let me stop you right there. The question is not should you buy. The question is, can you afford to buy? Can you afford to hold if it drops another 20%? Can you afford to wait 6 months, 12 months, maybe longer for this thesis to play out? Because if you can't, then it doesn't matter how bullish the fundamentals are. It doesn't matter how compelling the pattern is. If you're using money you need, if you're over-leveraged, if you can't handle more downside, then you shouldn't touch this market. One more time, if you're getting value from this analysis, smash that like button. Subscribe if you haven't. Turn on notifications and drop a comment. Can you afford to wait, or are you overexposed? Honesty matters. The MVRV Z-Score compares Bitcoin's market price to its fair value based on on-chain data. When the Z-Core is high, Bitcoin is overvalued. Euphoria, bubble territory, that's when smart money sells. When the Z-Core is low, Bitcoin is undervalued. Capitulation, blood in the streets. That's when smart money accumulates. In October 2025, when Bitcoin was at 126,000, the MVRV Z-Score was elevated. Not extreme, but elevated. The market was heated. Risk was high. That was not the time to go Allen. Today, at 72,000, the MVRV Z-Score has reset. It's back in the accumulation zone, the zone where historically, over multiple cycles, Bitcoin has formed bottoms and started new rallies. But here's the critical part. This is not a prediction. This is not a guarantee. This is just data. Historical data that shows us where we are in the cycle relative to past cycles. Could Bitcoin drop to 60,000 and make the MVRV even more attractive? Absolutely. Could we chop sideways for 6 months before any rally happens? Yes. Could I be completely wrong and Bitcoin never recovers? It's possible, though the data suggests otherwise. The point is this. If you're going to participate in this market, you need to understand the metrics. You need to understand the data, not so you can time the perfect bottom, but so you can make informed decisions instead of emotional decisions. But whatever you decide, make sure it's based on your risk tolerance, your financial situation, your time horizon, not based on what some YouTuber tells you, not based on what your friend did, not based on FOMO or fear. Let me bring this home. Bitcoin is at $72,400. It's down 42% from 126,000. The market is bleeding. Fear is at extreme levels. Everyone is scared. And you know what? Being scared is completely rational. This is scary. Watching your investment drop 42% is painful. It's stressful. It tests your conviction. It makes you question everything. But here's the difference between productive fear and destructive fear. Productive fear makes you ask, am I overexposed? Destructive fear makes you ask, is Bitcoin dead? One is a question about your position. The other is a question about the asset. And those are very different questions. But if you invested money you genuinely don't need, money you can afford to lose, money you won't touch for years, then ask yourself, what exactly am I scared of? Am I scared because the asset is broken? Or am I scared because the price is volatile? Because if it's the price, then you're reacting to noise. And noise is just part of the game. But if you can handle it, if you're properly positioned, if you're investing responsibly, then this is not the time to panic. This is the time to zoom out, to think long term, to remember why you bought Bitcoin in the first place. Let me be very clear about what I'm not saying. I'm not telling you to buy Bitcoin. I'm not telling you to hold Bitcoin. I'm not giving you financial advice. I don't know your financial situation. I don't know your risk tolerance. I don't know your time horizon. What I am doing is showing you the data, the fundamentals, the on-chain metrics, the historical patterns, and asking you to separate emotion from analysis, to separate fear from logic, to make decisions based on your situation, not based on what the market is making you feel. But whatever you choose, make sure it's based on rational analysis of your financial situation, not based on panic or FOMO. So here's my final challenge to you. Build conviction through education. Study the fundamentals. Understand the metrics. Know what you own and why you own it. Because conviction built on knowledge allows you to act when everyone else is frozen. Conviction allows you to sleep at night even when the price is dropping. Conviction separates investors from gamblers, but conviction without proper position sizing is recklessness. So before you do anything, ask yourself, can I afford to lose this? Can I afford to wait years for this thesis to play out? Can I sleep at night with this allocation? If the answer is yes, then you have clarity. If the answer is no, then you have work to do. Final call to action. If this video gave you a new perspective, hit that like button right now. If you're not subscribed, subscribe and turn on notifications because we're going to continue analyzing this market with data, not emotion. And drop one final comment. Conviction or panic? Let me know where you stand.